What if I told you that you could start earning income from luxury apartments in New York, massive shopping centers in California, high-tech data centers powering the internet, and even hospitals across America, without ever fixing a leaky roof, dealing with tenants, or taking out a huge mortgage? Most people believe real estate investing requires hundreds of thousands of dollars, strong credit, and years of management headaches. But what if there was a way to invest in real estate just like you buy a stock on the market with as little as the price of a single share? That's exactly where REITs come in. REITs, or Real Estate Investment Trusts, were created in 1960 when the US Congress made it possible for everyday investors to access large-scale real estate investments, the same way they invest in companies like Apple Inc. or Coca-Cola. Instead of buying one rental house, you can own a small piece of hundreds, sometimes thousands of income-producing properties across the country. And here's the most powerful part. By law, most REITs must pay out at least 90% of their taxable income to shareholders in the form of dividends. That means consistent cash flow potential, often higher than traditional dividend stocks. In today's world of rising property prices, inflation concerns, and uncertain markets, investors are searching for assets that generate passive income and provide diversification. REITs sit at the intersection of real estate and the stock market, offering liquidity, professional management, and access to sectors like apartments, warehouses, healthcare facilities, office buildings, and even digital infrastructure. In this video, I'm going to break down exactly what REITs are, how they work, the different types you need to know, the real advantages and hidden risks, and most importantly, how beginners can start investing the smart way. By the end, you'll understand whether REITs deserve a place in your portfolio and how they can potentially help you build long-term wealth without ever becoming a landlord. What is a REIT? Let's start with the basics. A REIT, or Real Estate Investment Trust, is a company that owns, operates, or finances income-producing real estate. Think of it as a company that buys large properties like apartment complexes, office buildings, shopping centers, warehouses, hospitals, or even data centers. Instead of you buying an entire building, a REIT allows thousands, sometimes millions of investors to pool their money together. In return, investors receive shares of the company, just like buying stock in a public corporation. REITs were created in 1960 when US lawmakers wanted to make real estate investing accessible to everyday Americans, not just wealthy individuals and institutions. Today, many REITs trade publicly on major exchanges like the New York Stock Exchange and the Nasdaq, which means you can buy or sell them through a regular brokerage account. One key rule makes REITs unique. They must distribute at least 90% of their taxable income to shareholders as dividends. That's why REITs are often associated with high dividend yields. Instead of reinvesting most profits like typical growth companies, REITs pass a large portion of income directly to investors. In simple terms, when you invest in a REIT, you're becoming a partial owner of a diversified portfolio of real estate properties that generate rental or interest income. You don't manage tenants, handle repairs, or negotiate leases. The REIT's professional management team does all that work for you. Your job: own the shares and potentially collect dividends. Types of REITs: not all REITs are the same. In fact, understanding the different types is crucial before you invest. There are three main categories: equity REITs, mortgage REITs, and hybrid REITs. Equity REITs are the most common type. These REITs own and operate physical properties. They generate revenue primarily through rent collected from tenants. For example, companies like Realty Income own retail properties and distribute monthly dividends, while Prologis focuses on industrial warehouses used for logistics and e-commerce. Equity REITs benefit from rising property values and increasing rents. Mortgage REITs, often called MRITs, work differently. Instead of owning buildings, they invest in real estate loans and mortgage-backed securities. They earn money from the interest spread, the difference between what they borrow at and what they lend at. These REITs can offer higher yields, but they are more sensitive to interest rate changes. Hybrid REITs combine both strategies. They own properties and also invest in mortgages, though they are less common today. Beyond structure, REITs are also categorized by property sectors. There are residential REITs, focused on apartments, office REITs, retail REITs, healthcare REITs, data center REITs, and even cell tower REITs. Each sector responds differently to economic conditions. For example, healthcare properties may be more stable during downturns, while office properties may struggle if remote work increases. Understanding these categories helps you diversify properly and choose REITs aligned with your investment goals. How REITs make money. Now let's talk about how REITs actually generate profits. For equity REITs, the primary source of income is rent. Tenants sign lease agreements, sometimes long-term contracts lasting 5, 10, or even 20 years. These leases create predictable cash flow. In many cases, contracts include annual rent increases tied to inflation. After collecting rent, the REIT pays operating expenses such as maintenance, property management, taxes, and interest on debt. The remaining income becomes profit, which is largely distributed to shareholders as dividends. Another way REITs make money is through property appreciation. If a REIT buys a property in a growing area and its value increases over time, selling it at a higher price can generate capital gains. Mortgage REITs earn income differently. They borrow money at lower short-term rates and lend it at higher long-term rates. The difference, known as the interest spread, is their profit margin. However, this model can be risky when interest rates rise quickly. You may also hear the term funds from operations, or FFO. Unlike regular earnings, FFO adjusts for depreciation and property sales to give a clearer picture of cash flow. Since real estate depreciation can distort accounting profits, investors rely heavily on FFO when evaluating REIT performance. In short, REITs generate income through rent, property appreciation, and interest spreads, and then distribute most of it back to investors. Benefits of investing in REITs. One of the biggest advantages of REITs is passive income, because they must distribute at least 90% of taxable income. Many REITs offer dividend yields higher than average stocks. For income-focused investors, this is extremely attractive. Another major benefit is accessibility. You don't need a huge down payment or a mortgage. You can start investing with the price of a single share. This lowers the barrier to entry compared to buying physical property. Liquidity is another key advantage. Unlike real estate, which can take months to sell, publicly traded REITs can be bought or sold instantly during market hours. REITs also offer diversification. Instead of owning one rental property in one location, you can gain exposure to hundreds of properties across different states and sectors. Professional management is another benefit. Real estate experts handle acquisitions, leasing, maintenance, and financing. This removes the stress of being a landlord. Finally, REITs can act as an inflation hedge. As inflation rises, rents often increase, which can boost revenue and dividends over time. Risks and disadvantages. While REITs offer many benefits, they are not risk-free. One major risk is interest rate sensitivity. When interest rates rise, borrowing becomes more expensive for REITs, and their dividends may become less attractive compared to bonds. Market volatility is another factor. Because publicly traded REITs behave like stocks, their prices can fluctuate daily, sometimes significantly. Economic downturns can also impact REIT performance. During recessions, tenants may default, vacancy rates may rise, and rental income may decline. Sector-specific risks matter too. For example, office REITs have faced challenges due to remote work trends. Dividend cuts are another possibility. Although REITs aim to provide stable income, dividends are not guaranteed. Lastly, REIT dividends are often taxed as ordinary income, which may be higher than qualified stock dividends. Public versus private REITs. Publicly traded REITs are listed on exchanges and offer transparency, liquidity, and regulatory oversight. Investors can easily track performance and buy or sell shares anytime. Private REITs, on the other hand, are not publicly traded. They may offer less volatility on paper, but often have limited liquidity and higher fees. Investors may need to commit funds for several years. Non-traded REITs fall somewhere in between. They are registered with regulators but do not trade on exchanges. For most beginners, publicly traded REITs offer the safest and most flexible starting point. REIT ETFs versus individual REIT stocks. If you prefer diversification, REIT ETFs may be the best option. For example, the Vanguard Real Estate ETF holds a broad basket of real estate companies across sectors. Buying individual REIT stocks allows you to target specific sectors, such as industrial or healthcare. However, this approach requires more research and carries higher concentration risk. For beginners, ETFs provide instant diversification and lower risk compared to picking one or two individual REITs. How to analyze a REIT? Before investing, look beyond dividend yield. A high yield may signal financial stress. Focus on funds from operations growth. Rising FFO often indicates healthy performance. Check debt levels. Too much leverage can be dangerous in rising rate environments. Review occupancy rates. High occupancy means stable rental income. Examine management track record and sector outlook. Smart analysis helps avoid yield traps and improves long-term returns. Best strategy for beginners. For beginners, the best approach is long-term investing. REITs perform best when held over years, not months. Consider dollar cost averaging, investing a fixed amount regularly, regardless of market conditions. Diversify across sectors or use a REIT ETF for simplicity. Reinvest dividends to benefit from compounding growth. Avoid chasing extremely high yields without understanding risks. REITs can be a powerful tool for building passive income and diversifying your portfolio, but like all investments, they require patience, research, and discipline. So here's the big takeaway. Real estate has created more millionaires than almost any other asset class, but for decades, it felt out of reach for the average person. REITs changed that. They opened the door for everyday investors to participate in large-scale real estate without massive capital, without mortgages, and without the stress of managing tenants. With just a brokerage account, you can own a piece of apartments, warehouses, hospitals, shopping centers, and even data infrastructure, and potentially earn consistent dividend income along the way. But remember, REITs are not magic. They move with the market. They react to interest rates. Some sectors perform better than others depending on the economy. That's why smart investing always comes down to strategy, diversification, and long-term thinking. If you focus on strong fundamentals, reinvest your dividends, and stay patient during market volatility, REITs can become a powerful income-generating pillar in your portfolio. The real question now is this: do you want to be the landlord fixing roofs at midnight, or the investor collecting dividends while someone else handles the hard work? Let me know in the comments, would you rather invest in physical property or REITs? If this video helped you understand REITs clearly, make sure you hit the like button, subscribe for more smart investing content, and turn on notifications so you don't miss the next breakdown. In the next video, we'll dive into the best REIT sectors to watch and how to identify high-quality REITs for long-term wealth building. Your journey toward smarter passive income starts now.